Hello and welcome to your weekly technical update, your guide to the charts that matter this week. I'm Andrew Gagan. Well, energy has been among the worst performing sectors globally this year, while the composition of energy stocks on the S&P 500 is currently around 3%, whereas it used to be as high as 14%. Michael Gable from Fairmont Equities looks at the local sector with a focus on Woodside and the coal stock TER.
So I think that as people realise that the demand is still going to be there for oil and gas, and there's been a lack of supply, you'll get a movement up in price. So in terms of Woodside, this is a weekly chart. To me, it looks like it's going through a bottoming phase. So it is a stock that we picked up several weeks ago for clients. I think if it cracks that blue line, which is near, I think it's near $27, then you've got confirmation that a major low is in place and it can go for a run. So I really like the way Woodside's trading here.
All right, let's now focus on a coal stock in TER. Now, if you've been holding this for the last 2 or 3 years, it's been a bit of a miserable ride, hasn't it?
Yeah, and this chart actually doesn't tell the full story because the stock's down, I think, 90% from its recent peak. So look, it's a small company, obviously with coal. Coal's a dirty word. No one's really investing in new mines. So if you own a coal mine, if demand picks up, then you're in a good position. So it's not moving yet, but again, I see bottoming signs with this particular stock. I like the way that it's trading sideways. The range is tightening up. It's sitting just under a resistance level there, which is just over 9 cents. So to me, this looks like it's on the cusp of breaking out of a base. So I think this is one for our viewers to keep an eye on.
Well, uranium has been a very volatile subsector of energy, with uranium stocks among the most shorted on the ASX. Michael Gable analyses DYL, which he sees as being oversold.
CEO depart in October, but ultimately, as long as the business isn't doing anything wrong, it'll just go up with a rising uranium price. We've started to see the price rise. It hasn't really hit its stride yet, but I just like the way that DYL sort of bottomed out here, just above it's rounding out just above a major support level. So I'd expect some accumulation to start occurring here. We know that the US just recently added uranium to their critical minerals list, and they're possibly going to announce a strategic reserve. I wouldn't be surprised if we start getting some catalysts pretty soon. So yeah, this one looks like it's at a good price to pick up.
David Franklin from Argonaut Funds Management sees uranium as being a commodity that's well placed to perform strongly in 2026, with the spot price at around $76 a pound, while the contract price is closer to $80 a pound. David takes a look at emerging disruptor in the industry, NextGen.
So to put it in context, it's Rook Arrow project in the Athabasca Basin potentially produces 25 to 30 million pounds of uranium per annum, and that should be in production by around 2030, 2031. So that puts it in the same league as Cameco, but its market cap is about 8 billion. It's probably got 3 billion to spend to develop it. So you can see that there's good upside in that it is the emerging leader in the sector. Now it's just going through the final stages of its approvals. It had its first assessment by the Canadian Nuclear Safety Commission, the CNSC, on the 19th of November. There's a follow-up meeting in February, and then we're expecting the final decision in March, and then it's full steam ahead for that project. So that's really going to be the one to watch, I think, in the sector.
And that's it for this week's edition of The Charts to Watch. Join us for more technical talk next week. Happy trading.